So, you want to own a casino? Picture it for a second. Marble floors that never quite go dark. A gaming floor humming at 3 in the morning with the specific electronic chatter of 1,000 machines that never sleep. High rollers stepping out of black cars, comps rooms waiting, bottles already chilling. And underneath all of it, one phrase everybody already believes before they've even walked through the door: the house always wins. It's the cleanest business fantasy in the world. You don't need to sell anything. You don't need to convince anyone. The math is already rigged permanently in your favor, built into every card, every wheel, every reel. People will hand you their money voluntarily, over and over, for the privilege of losing it slightly slower than the odds say they should. What could possibly go wrong owning a machine like that? Here's what the fantasy conveniently leaves out. In 2025, the Las Vegas Strip pulled in over $21 billion in total revenue, one of the highest totals in its history. And in that same year, the collective net income of the Strip's major casino operators didn't just dip. It collapsed by over 80%, falling to roughly $154 million across dozens of resorts that, combined, generate more money in a single month than most American cities generate in a year. Read that twice. Record revenue. Near total profit collapse. In the same 12 months. If the house always wins, somebody forgot to tell the house a balance sheet. So which is it? Is owning a casino the closest thing capitalism offers to a guaranteed, rigged-in-your-favor money machine, or is it one of the most capital-hungry, debt-fragile, quietly merciless businesses in the entire hospitality industry? The uncomfortable truth is that both statements are true simultaneously, depending entirely on which part of the casino you're looking at, and almost nobody watching the marble floors and the free drinks ever gets shown the part that actually determines whether the owner survives. On the surface, the casino business looks almost embarrassingly simple, at least mathematically. Every game on the floor is built around a fixed statistical edge in the house favor. Blackjack, played with basic strategy, gives the house an edge of roughly 0.5%. Baccarat sits a little higher, just over 1%. Roulette, depending on the wheel, sits in the neighborhood of 2 to 5%. Slot machines, the single largest revenue generator on almost every casino floor, are programmed to hold somewhere between 7 and 10% of everything wagered through them, spinning tens of thousands of times a day, every day, without needing a single employee to close a sale. Multiply a small percentage edge across millions of individual bets a night, and the law of large numbers does the rest. Individually, any single hand, any single spin, any single roll of the dice is genuinely uncertain, a real coin flip, weighted slightly. But run that same uncertain event 1,000,000 times in a single week, and the outcome stops being a gamble at all. It becomes something closer to a predictable manufacturing process, with gambling as the raw material and cash as the finished product. This is the version of the casino business that lives in the popular imagination, a mathematically bulletproof machine, printing money on a fixed margin, immune to bad luck because bad luck cancels itself out at scale. And for the games themselves, that description isn't wrong. The house edge is real, it's permanent, and over any sufficiently long time frame, it will win. But here's the part that fantasy skips entirely. The games themselves are almost never the thing that actually determines whether the person who owns the casino makes money. That distinction changes everything about how this business actually works. Here's the reframe, and it's the single most important idea in this entire video. A modern casino does not primarily sell gambling. It sells real estate, hospitality, and an experience, and gambling has quietly become just one department inside a much larger operation. Look at what actually happened on the Las Vegas Strip in 2025. Total resort revenue crossed $21 billion. Of that entire figure, gaming win, meaning the money actually won from wagering, from every slot machine and table game combined, made up only about 26% of total revenue. The remaining 74% came from hotel rooms, restaurants, nightclubs, retail, entertainment residencies, and convention business. Sit with that number. 3 out of every $4 flowing through a Las Vegas Strip resort today has nothing directly to do with a card, a wheel, or a reel. The casino floor, once the entire identity of these properties, has become the anchor tenant inside something closer to a vertically integrated hospitality and entertainment conglomerate, one that happens to still have a gaming floor at its center, both because it's historically iconic And because gambling revenue, while now a minority share, still carries the highest margins of anything sold under that roof. This reframing matters because it changes what actually determines success. If gambling were still the whole business, the fixed house edge alone would make casino ownership close to a guaranteed win, mathematically difficult to lose, structurally protected from most forms of operator error. But once 3/4 of your revenue comes from hotel occupancy rates, restaurant margins, entertainment booking costs, and convention calendars, you've inherited every risk that comes with running a capital-intensive hospitality business: labor costs, seasonal demand swings, competitive pricing pressure, and the ever-present threat of a slow travel year. The house edge protects the gaming floor. Nothing protects the hotel wing, the steakhouse, or the nightclub from an ordinary bad year in tourism. So what does it actually cost to get into this business? The honest answer is that a casino isn't one price point, it's an entire spectrum, and the gap between the bottom and the top of that spectrum is almost incomprehensibly wide. At the smallest end, a modest slot parlor or a limited stakes regional casino, a few hundred machines, a handful of table games, no hotel tower attached, can realistically be built and licensed somewhere in the range of $2 to $20 million, depending heavily on jurisdiction and scale. That's the version of owning a casino that exists in smaller regional markets, riverboat jurisdictions, and some tribal gaming operations. Step up to a full-scale destination resort casino, the kind most people actually picture when they hear the word, and the number changes by orders of magnitude. The Fontainebleau in Las Vegas, which opened in late 2023, cost approximately $3.7 billion to build. Encore Boston Harbor, developed by Wynn Resorts, cost around $2.6 billion. Even outside the marquee Las Vegas and Atlantic City markets, a large tribal casino resort like Alani in Washington state still required over $500 million in construction capital. For a genuinely large-scale property, several thousand slot machines, dozens of table games, a full hotel tower, multiple restaurants, a theater, a spa, total construction costs regularly run into the billions before a single guest has checked in. And construction is only one line item. Before a shovel even touches the ground in most jurisdictions, there's the licensing gauntlet. And this is where the casino business separates itself from almost every other industry covered on this channel. In Nevada, an unrestricted gaming license can run into the hundreds of thousands of dollars just in application and investigative fees. In New York, state regulators set a minimum license fee of $500 million for each of its downstate casino licenses, on top of a $1 million non-refundable application fee just to be considered. That's not a typo. $500 million before construction, before a single card is dealt, purely for the legal right to operate. Layer onto that the cost of background investigations into every owner, executive, and major investor, sometimes running tens of thousands of dollars per person, mandatory anti-money laundering infrastructure, surveillance systems that can cost $15 to $25 million on their own for a large property, and a casino management system for player tracking and compliance that adds another $20 to $60 million in technology spend. Then comes the part almost nobody budgets for correctly, the cage. Every casino needs enough liquid cash on hand at all times to cover jackpots, chip redemptions, and player payouts. For a mid-sized property, that minimum bankroll alone can sit between $1 and $1.5 million, sitting idle in a vault, earning nothing, existing purely as a regulatory requirement to prove you can pay out if the house happens to lose on a given night. This is the part the fantasy never mentions. You're not just building a building and installing slot machines. You're financing a government-supervised, cash-intensive financial institution that happens to also serve steak dinners. Once the doors are open, the revenue engine runs on 3 distinct layers, and understanding how they interact explains almost everything about why this business behaves the way it does. The first layer is the gaming floor itself, the part everyone already understands intuitively. Slot machines generate the largest single share of gaming revenue in most casinos, precisely because they require no dealer, run 24 hours a day, and their hold percentage is fixed by the machine's programming rather than by player skill. Table games generate less total volume but carry their own dynamics. A single high-stakes baccarat player can swing a casino's monthly table revenue up or down by millions of dollars, because at that stakes level, the law of large numbers hasn't fully kicked in yet. This is why casino win percentages bounce around meaningfully month to month, even though the underlying house edge never changes. Luck genuinely evens out over a year. It does not reliably even out over a Tuesday. The second layer is the entire non-gaming ecosystem sitting on top of the casino floor. And as we've established, this is now the larger half of the business. Room revenue, food and beverage, nightlife, retail, entertainment residencies, convention and meeting space. These revenue streams behave nothing like the gaming floor. They're not protected by a mathematical edge. They compete on price, quality, and experience, the same as any hotel or restaurant anywhere else in the world, except with a dramatically higher cost structure, because everything on a casino property is built to a luxury standard in order to keep guests inside the building and near the gaming floor for as long as possible. The third layer, and the one that quietly explains the entire psychology of the business, is the comp economy, the system of complimentary rooms, meals, drinks, and entertainment given to gamblers based on their theoretical value to the house. A player's worth isn't measured by what they actually win or lose on a given trip. It's measured by theoretical win, average bet size, multiplied by hours played, multiplied by the house edge on their chosen game, producing a statistically expected profit the casino can bank on over that player's lifetime relationship with the property. A high-stakes baccarat player might be offered a free suite, private jet transportation, and a 5-figure dining allowance, not out of generosity, but because their theoretical value to the house, calculated with actuarial precision, comfortably justifies the expense. This is, in effect, a customer acquisition and retention budget run with the same cold math an insurance company uses to price a policy. The generosity is real. The math behind it is ruthless. Underneath all three of those revenue layers sits a cost structure that explains exactly why the Las Vegas Strip could post record revenue and a near total profit collapse in the same year. Labor is the single largest ongoing expense for most large resort casinos, and it's a labor force unlike almost any other in hospitality: dealers, pit bosses, surveillance staff, cage cashiers, hundreds of housekeeping and food service employees, security personnel, and a compliance department large enough to satisfy state gaming regulators around the clock. Unlike a restaurant that can trim staff during a slow season, a licensed casino floor has mandatory staffing ratios tied directly to its gaming license. You cannot simply run a smaller crew on a quiet Tuesday if regulations require a certain level of table coverage and surveillance presence. Utilities and maintenance on a property this size are staggering. A resort with thousands of hotel rooms, multiple restaurants, a full gaming floor, and often a spa or entertainment venue runs a building footprint closer to a small city than a single business. Climate control alone, running 24 hours a day across millions of square feet, represents a massive fixed cost that barely moves whether the property is at 40% occupancy or 95%. Then there's compliance itself, which never stops costing money after opening day. Currency transaction reports, anti-money laundering monitoring, ongoing background checks on new hires and vendors, ongoing licensing renewal fees, and regulatory audits all require permanent staff and legal counsel. A single miscompliance filing can trigger fines running into 6 figures and put the operating license itself at risk, which means compliance isn't treated as a controllable cost the way it might be in most industries. It's treated as a fixed cost of existing, regardless of how the gaming floor is performing. And finally, there's debt service, arguably the most decisive line item of all, because almost no casino resort of meaningful size is built with cash. These properties are financed with enormous construction loans and bond issuances, and that debt has to be serviced whether the property is thriving or struggling. This single fact explains the 2025 Las Vegas Strip numbers better than almost anything else. Revenue can hit records, but if fixed costs, labor, debt service, utilities, compliance are rising at the same time discretionary spending on rooms and dining is softening even slightly, net income can evaporate with startling speed because so little of a casino resort's cost structure is actually variable. The building doesn't get cheaper to run just because fewer people checked in this month. So why does a business built on a mathematically guaranteed edge keep producing spectacular, headline-making failures? The first trap is leverage. Because these properties cost billions to build, almost none of them are built with equity alone. They're financed with debt stacked on debt, often through complex bond structures with strict repayment schedules. A casino doesn't need to lose money to fail. It simply needs to generate slightly less cash flow than its debt service requires for long enough, and the entire structure can collapse regardless of how the actual gaming floor is performing on any given night. The second trap is the sheer size of the fixed cost base. Once you've built a $3 billion resort with thousands of hotel rooms and a full entertainment calendar, you cannot simply shrink the building during a slow year. The cost of running the property is largely locked in at the moment of construction, which means demand shocks, a recession, a competitor opening nearby, a shift in travel patterns hit the bottom line almost immediately and almost entirely, with very few levers available to soften the blow. The third trap is oversaturation, and it's a risk almost unique to how casino licensing actually works. Because gaming licenses are granted by regional and state governments hungry for tax revenue and job creation, new markets keep opening, new states legalizing gambling, new tribal compacts, new regional licenses, even when existing markets are already saturated. A casino built assuming a certain regional customer base can watch that customer base fragment overnight when a neighboring state legalizes its own casinos, or a nearby jurisdiction adds table games where previously only slots were allowed. The house edge protects you from your own customers losing less than expected. It does nothing to protect you from a competitor opening 45 minutes down the highway. The fourth trap is regulatory dependency itself. Unlike almost any other business on this channel, a casino's entire right to exist can be revoked by a state gaming commission for compliance failures that have nothing to do with the underlying profitability of the business. You can be running a financially sound property and still lose everything over an anti-money laundering violation, an unsuitable investor, or a failure to maintain required surveillance standards. The license is not just a cost of entry, it's a permanent, revocable dependency that sits above every other business decision for the life of the property. No case study captures these traps more completely than the story of Revel Casino Hotel in Atlantic City. Construction began in 2007. Backed initially by Morgan Stanley, which committed $1.25 billion to the project, with plans for a 40-story glass tower designed to attract a different clientele entirely, Wall Street bankers and high-end travelers, rather than the day-tripping bus crowd that had defined Atlantic City gambling for decades. Then the financial crisis hit. Construction stalled. By 2010, with the project only 60% complete, Morgan Stanley walked away entirely, booking a $932 million loss on its stake. Financing dried up. The project needed another $1.4 billion just to finish, and it took desperate fundraising across more than a dozen hedge funds to get the doors open at all. Revel finally opened in April 2012, 4 years behind schedule, carrying a construction cost that had ballooned to $2.4 billion, one of the most expensive casino resorts ever built outside of Las Vegas or Macau. The concept was ambitious: a total smoking ban, no bus tour deals, no traditional players club, positioning itself as a seaside luxury escape that just happened to have a casino inside it. Within its first month, the gaming floor pulled in just $13 million, placing it near the very bottom of Atlantic City's 12 casinos, a ranking it never meaningfully improved on for the rest of its existence. The debt load was the real killer. Revel opened so heavily leveraged that even reasonably solid operating performance couldn't cover its obligations. It filed for bankruptcy in March 2013, less than a year after opening. It filed again in June 2014. On September 2, 2014, 2 years and 5 months after its grand opening, Revel closed permanently, laying off close to 3,000 employees. The property that cost $2.4 billion to build sold at bankruptcy auction for $82 million, 4 cents on the dollar. Wall Street's total losses on the project are estimated at roughly $2.5 billion. What makes Revel such a precise illustration of this business isn't that the casino itself failed at gambling. The games worked exactly as designed. The house edge functioned exactly as intended every single day it operated. Revel failed because it was, underneath the marble and the glass, a $2 billion real estate and hospitality bet financed almost entirely with debt, built on assumptions about a customer base and a market recovery that never materialized on schedule. The casino floor was never the problem. The capital structure was. And Revel isn't an isolated historical anomaly. It's a preview of a pattern still playing out today. Look again at the 2025 Las Vegas Strip numbers. Over $21 billion in total revenue, one of the highest totals on record, and yet combined net income across the Strip's major operators collapsed more than 80%, down to roughly $154 million. Analysts pointed to the same underlying mechanism that sank Revel, just operating at a gentler pace, fixed operating costs and debt obligations continuing to climb while discretionary guest spending on rooms, food, and beverage softened even slightly. Revel died from this dynamic in 2 years. The modern Strip is currently absorbing the same pressure in slow motion, one fiscal year at a time, propped up by gaming revenue that, remember, now makes up barely a quarter of the total business. In a good year, a well-capitalized casino resort is one of the most efficient cash-generating machines in modern business. Rooms sell near capacity. High-value players return on a predictable cycle, their theoretical win comfortably justifying every comp extended to them. Convention business fills weekday gaps that would otherwise sit empty. The mathematically guaranteed house edge quietly compounds in the background, contributing dependable margin underneath a hospitality operation that's also firing on every cylinder. In this version of the story, the fantasy is basically true. The house wins consistently, and the owner behind the house wins right alongside it. In a bad year, the same property can look almost unrecognizable. A regional recession softens discretionary travel spending. A neighboring state legalizes competing casinos, fragmenting a customer base that used to be captive. Convention calendars thin out. Room rates that once commanded a premium have to be discounted to maintain occupancy, compressing the 74% of revenue that has nothing to do with the mathematically protected gaming floor. Meanwhile, debt service doesn't care what kind of year you're having. The payment is due regardless. This is exactly the dynamic that surfaced across the Las Vegas Strip's own 2025 numbers. Near record top-line revenue and a net income figure that evaporated almost entirely once fixed costs were accounted for. The unsettling part is that both of these scenarios can involve the exact same gaming floor, performing exactly as its house edge always promised it would. The volatility isn't coming from the cards or the dice. It's coming from everything built around them. The deepest lesson inside the casino business isn't really about gambling at all. It's about what happens when a mathematically guaranteed edge gets buried underneath an enormous, debt-financed, fixed-cost hospitality operation. We tend to assume that a guaranteed statistical advantage should translate directly into a guaranteed business outcome. Casinos prove that assumption wrong at a scale few other industries can match. The house edge on the gaming floor is as close to a permanent, physics-level truth as exists anywhere in commerce, and it still isn't enough, on its own, to protect an owner from bad financing decisions, oversaturated markets, or a fixed-cost structure that doesn't bend when demand softens. The wider lesson applies well beyond casinos. Any business that layers a genuinely strong core advantage underneath an enormous, capital-intensive, largely fixed-cost operation inherits risks that have nothing to do with that original advantage. The edge doesn't disappear. It simply stops being the thing that decides whether the business survives. The house always wins, but the house was never the whole business. It's the one department inside a billion-dollar hospitality operation that happens to be mathematically guaranteed, sitting on top of thousands of hotel rooms, hundreds of millions in debt, and a fixed cost structure that doesn't know or care what the dice are doing tonight. Somewhere behind every casino's glowing marquee is a much quieter number, a debt schedule, a fixed labor cost, a construction loan coming due that was never subject to the house edge at all. And in the end, that number, not the roulette wheel, is usually the one that decides who actually walks away a winner.